Let's get some insights to the news shaping the markets. And for that, we welcome in William Lee, Chief Economist at the Milken Institute. Thank you so much for being here. We see a market that is uncertain.
Yeah.
To what do you attribute that?
I think the political scene has really come on to be a little bit more clarified, but that clarification brings along with it some risks. I think one of the things that we should expect from whatever administration gets in is that growth is going to be pretty good. We'll be growing somewhere in that 2% range, but the inflation outlook now has become highly uncertain. If the Republicans get in, we can expect a huge amount of deregulation and a lot of drilling, so a lot of energy costs will be going down. And if the Democrats get in, it's the opposite. We're going to expect some more regulation and less drilling, and energy costs will go up. But I think the trade policy is the most important thing that that markets should keep in mind. Whoever gets in, the trade policy is going to be continuing to bring production back onshore and back home. They're going to be shortening up the supply chains. And I think a lot of the globalization vulnerabilities that we saw during COVID will be reversed by either party. So I think those kind of uncertainties, I think, are things that the markets are having to deal with right now.
And I think that was well said, Bill Lee. Also, how about what the Fed does or does not do? What do you think the Fed should do, and what will they do, right? Another element of uncertainty. I mean, we could go on all day. Tell me a little bit about your thoughts on the Fed.
That creature that's down the street on Pennsylvania Avenue called the Fed is certainly on the market's mind. I think the Fed is in a position to start lowering rates. One of the vulnerabilities in the U.S. economy right now is that high interest rates are holding back a lot of growth. The auto sales are going nowhere because of financing costs. Home sales are going nowhere because people have locked into their high mortgage, the low mortgage rates, and supply is not there, and the new buyers are not getting the mortgage they need at the lower rates. But the Fed is telling us they're ready to move. They have to see a couple of more good data points on inflation, and bang, they're there. And I think one of the things that we'll see from the PCE numbers this Friday is verification of the downward trend that Chair Powell has told us has given him some good vibes about cutting probably in September and at the latest by November.
Yeah, you were in the camp that they should have cut some time ago, right?
I thought they should have cut, depending upon where the data points came in. I said to everybody, it takes 3 to 5 data points to get a trend. And the Fed just wasn't confident that they had a downward trend going. And now that we are closer to that 3 to 5 data points that gives them that downward trend, I'm getting more and more convinced that they're ready to cut, especially as the economy starts to slow. Although I should say the market commentators are going nuts about how weak the labor market is. And I want to emphasize to our audience that unless the unemployment rate pops above 4.5%, that's not going to get the Fed all excited. For them, 4 to 4.5% unemployment rate is normal, and that's exactly where we are right now.
Yeah, look, we have a busy week ahead. You mentioned the PCE on Friday. We'll have consumer sentiment, GDP, new home sales. We have a lot to digest ahead of the Fed's meeting. Any of these stand out to you? Durable goods. What are you expecting and watching for in particular?
Durable goods. That to me has been always a good indicator for where investment spending is going. When the GDP numbers come out, everyone should focus like a hawk on the line that says business fixed investment on research development and software. Those are the components of investment that have always led to higher corporate profits. So regardless of where the Fed goes, even if they delay their rate cuts, if the markets see that businesses continue to spend, especially on the AI and research and development and new tech type stuff, that will lead to higher corporate profits regardless of where interest rates are. So I would focus on those elements. Is durable good spending still there? And more importantly, are the GDP numbers showing that companies still want to invest?
Yeah. I was listening to Vice President Kamala Harris last night, and she was talking about higher wages for everybody and more affordable health care for everyone and child care for everyone and so on and so forth. And I began to wonder, it sounded like a utopia. I just don't know how we pay for that. How do we pay for all of that?
Exactly the point, Nicole. In fact, the one place where the markets have not focused enough worry about government is how do we pay for all the goodies that government is promising? Both parties. We at Milken are nonpartisan, and we both are sounding the alarm about how high the debt burden is growing. The CBO is telling us that right now the debt per GDP is somewhere in the 90% level. It's going to be over 110% by the time 2030 rolls around. By the time 2035 rolls around, it's going to be knocking on 120%. Those are the kind of numbers that freak markets out. And people are going to continue to ask the question: will U.S. dollar remain dominant? Will countries continue to absorb the kind of excess spending that we're on our trajectory now? As Chair Powell says, 94% of GDP is manageable, no problem. But as we start to push into the 110, 120% of GDP levels of debt, especially as interest rates normalize at a slightly higher level, because our higher productivity would warrant a higher real interest rate, those are the things that should worry markets, and the markets have not begun to even think about that yet.
Yeah. Quickly, just would you tell folks to invest in the market currently? Do you feel confident enough in the economy, I guess, and the outlook?
I don't need to tell people global investors are coming in droves, and that kind of capital is what we need to keep interest rates low. As long as the U.S. remains the best place in the world to invest because our technology is and innovations are better than anywhere else, that's going to assure that the U.S. will continue going. Our big competitor out there, though, is China. They are on a track of trying to spend like crazy on exactly the same high tech and AI products. So we need to watch out what's going on there.
Yeah. Billy, great to see you. Thank you so much from the Milken Institute. Always love when
Thanks,
you're on
man.
the show. Thank you.